All right, so we're coming up on the end of the year, which is when a lot of our clients will make annual gifts. And for our clients that are over the age of 70 and a half, especially those that are taking required minimum distributions, a strategy that we will discuss is something called a Qualified Charitable Distribution, or a QCD. Now, how a QCD works is actually pretty simple. You just make a gift directly from your traditional IRA to a charity. But why it can be more beneficial to make a QCD as opposed to just writing a check is a little bit harder to understand. And so what I want to take a look at today is just a really simple tax return of a couple. And in one scenario, they make a gift of cash. And then in the other scenario, they make a QCD. And then we can see the impact that it has on their federal tax liability. So this tax return is going to be really simple. There's not a whole lot going on here. Again, just to keep this example as easy as possible. But what you'll notice is that they have to take RMDs this year. And so the amount of their RMD is $75,000. And they also have gross Social Security income of $65,286. Now, if we scroll down a little bit, here's where you will see that gift to charity recorded, and that counts as what's called an itemized deduction. And the way that the tax code works is that you can reduce your adjusted gross income by either your standard deduction or the total of your itemized deductions, which can include things like state income taxes paid, it can include property taxes, it can include charitable giving. And in this scenario, their charitable giving and their other itemized deductions actually add up to less than their standard deduction. And so they reduce their adjusted gross income by their standard deduction, and that comes up with taxable income of $99,793. And so in this scenario, the client isn't actually receiving any kind of tax benefit for the charitable giving that they are doing because of the way that the tax code is structured. Now, the impact of all of this on their federal tax liability is that they end up paying $12,569 in federal taxes. Now, what if this same couple, instead of writing a check for $25,000, made a $25,000 QCD? What would their federal tax liability be? Let's take a look. And you can see that their federal tax liability drops from $12,569 all the way down to $6,538. So it's nearly cut in half, which is a pretty profound impact for a gift of this size. Now, why is this taking place? Well, there's really three reasons. And the first is that this client just isn't giving in the most tax efficient way, because as I pointed out, they aren't receiving any kind of tax benefit for the giving that they are doing. In scenario one and in scenario two, the taxpayers can reduce their adjusted gross income by the same amount. So that's the first reason. The second reason is that the amount of the IRA distribution that is subject to tax in scenario two is reduced by the amount of the qualified charitable distribution. So it's important to note that this client is still fully satisfying their RMDs, but instead of the full $75,000 being subject to tax, only $50,000 of it is subject to tax because $25,000 is getting sent to a charity. Now, because they are reducing the amount of their IRA distribution that's taxed, they're also pulling down something called their provisional income. And provisional income is how we calculate the amount of your Social Security income that is subject to tax. And so as their provisional income comes down, so does their taxable Social Security income. And so the net impact of all these things is that they reduce their taxable income by almost $42,000. And that's why we're seeing such a large impact from a gift of this size. Now, again, this is a pretty simple example. The impact isn't always going to be this large. And if you're going to go about a QCD, you really want to make sure that you're working with a CPA to make sure that all the reporting is done correctly. You also want to make sure you're working with a financial advisor just to understand short-term and long-term implications and whether or not there's actually a benefit from this. So make sure that you're working with the appropriate professionals. If you have questions about QCDs, if you have questions about giving strategies, we would love to chat with you. So please don't hesitate to reach out to any of the advisors here at Beacon Wealth Care. Thank you.